My name is Andrew Stotts, and I want to welcome you to this final presentation of one of my Valuation Master Class students. We're talking about 3 months of work, hundreds of hours of learning, valuing 9, 10, 11, 12 companies, providing feedback and receiving feedback from the professional community of the Valuation Masterclass. And now it all comes down to this final presentation. Let me bring him into the room. Ayush, how are you?
I'm great. How are
Um,
you, Andrew?
I'm good. And I'm really excited to learn about Palo Alto because I really don't know that much about this company. And I think there's probably some people out there that know it, but for the rest of us, it's pretty new. Why did you
Yes.
choose this company, by the way?
So it's a exciting company. Palo Alto Network is one of the companies that is still maturing. There is a lot to learn about there in the cybersecurity industry. The threats in the industry is continuously increasing, and due to that, there is a lot of fluctuation. There is a lot to know about, and if you know better, you can price it better, and you can help investors gain a lot of profit. That's my reason.
Okay, excellent. And just introduce yourself briefly so the audience knows where you are and what you're doing.
Yeah. So I am based in Mumbai. I am currently doing my BTech and MTech program in AI. So that's why one of the reasons about taking Palo Alto Network is to see how AI is penetrating this industry. Yeah, that's pretty much about me.
Fantastic. All right. Well, what I'm going to do is pull up your presentation now,
Okay.
and I see that on the screen, and I think we're going to be ready. So, what I'm going to do is I'm going to leave in just a minute, and when I leave, you take over. All
Sure.
right. And for the audience out there, for those that are watching, feel free to put your questions in the chat, and we're going to look at questions after Ayush is done presenting as well. You may see this in a week or so. You can still leave your comments and questions in the chat because we still watch and see what you guys say. All right. So I'm leaving. So you take it over now.
Okay. So, hi everyone. Thanks for joining my presentation on Palo Alto Network. I initiate my coverage on Palo Alto Network with a buy recommendation. Against a current target price of 184, I am recommending a target price of 217 US dollars, implying a 18% upside potential. Now, let us look at some of the key valuation story that is driving this wave for Palo Alto Network. Before that, let's quickly look into the background of Palo Alto Network. So it was started in 2005 by Nirzuk, who was a former engineer at Checkpoint and NetScreen Technologies. So he left it out to focus on modern cryptographic challenges, solving it through AI integration and platformization. Post that, Palo Alto Network has been growing consistently. Recently, most of the cybersecurity companies have switched to platformization strategy. In this strategy, cybersecurity companies bundle together multiple cybersecurity products rather than selling one particular product. This helps these companies to gain more customers, bigger deals, and also increase the customer retention. While Palo Alto Network has surely not been the first mover, it has been a quick mover, and seeing its competitors gain 50% year on year increase in its earning, Palo Alto Network also switched to this strategy, and since then it has seen 13% increase in $10 million deals and 30% increase in $5 million deals. This has been a great for Palo Alto Network's earning potential, which we will look forward going in the presentation. So Palo Alto Network is also a human resource powerhouse. As you can see, the net income per employee is highest in the industry with $176,000 made by every employee, which is 34% higher than its next competitor. And you can see on this graph how it compares with its other competitors. We will understand the significance of this when we will move forward to constraints to the growth, and we will see human capital is one of the most severe constraints to growth, and why managing effective human capital is important. So let's see. Palo Alto Network has been making consistent growth in its overall revenue, but the rate of growth of revenue has been consistently decreasing from 20% to 14%. It has started to increase after quarter four of 2024. However, it remains key to see how platformization strategy, which we have talked about earlier, is going to shape this. if this is going to be successful, the revenue growth rate is going to kick back, and I most certainly hope that this is going to happen, but it still remains a key risk to be seen. So now let us look at some of the major growth stories. So Palo Alto Network saw a huge jump in net profit in 2024. This is largely due to a one-time adjustment reserve for valuation of deferred tax assets. This happens when the company ascertain that the certain call for income tax won't happen, and then the deferred tax assets from the balance sheet comes to the income statement, and it's recorded as overall income. Some of the latest news surrounding Palo Alto Network is its $100 million acquisition of IBM's QRadar SaaS asset, its $100 million contract with UK's Home Office, again showing the effectiveness of platformization strategy, as Palo Alto Network can consistently make out big deals. It's also has introduced quantum random number generator. This is to protect its clients against quantum cybersecurity attack, which is going to be the future. So now let us look at some of the constraints to growth. So constraints to growth are divided into capital, operations, market, and people, which are the four major things that may hinder companies' future growth against the current growth. So capital looks a minor constraint for Palo Alto Network, as Palo Alto Network is making huge cash flows year on year, and it doesn't have any long-term debt as of now. Operations seems a neutral risk, as most of its operations is sorted, but it has a serious dependence on its original equipment manufacturer Flex, that manufactures hardware for Palo Alto Network. While they have a strong relationship going years back, it may still choke Palo Alto Network if there is any problem occurring with Flex. So let's look at market. Market for Palo Alto Network is a very minor risk, as cybersecurity market is consistently growing, with cybersecurity attacks wiping out $9.22 trillion from global economy in 2024, and this number is expected to increase to $13.82 trillion by 2028. This has made many smaller and many big conglomerates understand the importance of a cybersecurity tool with them, and they are consistently moving towards modern cybersecurity providers like Palo Alto Network. Also, now let us look at the people constraint of people. Now, as I've talked about earlier, people is the most major constraint in this industry. As you can see on the graph, the amount of demand to supply is 130% in 2012. That means for every one person required in cybersecurity industry, there were 1.3 people available. But at present, it's just the opposite. For every one person required, for every 100 person required, there is only 69% available for this. So there is a huge fight between all the small startups as well as big companies like Google and Microsoft, legacy companies who are trying to develop their their in-house capabilities for cybersecurity. Now let us look at revenue structure for Palo Alto Network. Palo Alto Network derives 64% of its revenue from United States, 20% from Europe, 12% from Asia Pacific, and rest from other Americas. Palo Alto Network has major two components, which is product and subscription. While the shift was making 50-50% in 2016, it's now almost 80% in subscription and 20% in product revenue. This is a consistent strategy utilized by Palo Alto Network to reduce its overall payables, and this has so far helped Palo Alto Network. So Palo Alto Network overall revenue growth was 15% in 2024, where 25%, 0.6% came from subscriptions and 13% from support services. Now, let us look at Palo Alto Network's overall uh, FEMR chart. So, FEMR is fundamental, valuation, momentum, and risk. These are the four major factors that Andy Schwartz research has picked out over the years for seeing in a particular stock. For Palo Alto Network, fundamental seems to be below average, as company has a poor asset utilization. Its valuation is also below average, as the company is trading on a high P and high PB compared to other companies in the US market. Its momentum seems to be good, as is for other technology sector stocks in the US, especially because there is a huge bubble in the market around AI, around technology. but the risk again is below average as the company is currently trading on a low current ratio. Now, let us look at Porter's 5 force analysis for Palo Alto Network. So, Professor Michael Porter has determined five major factors that we will look forward uh, towards determining the competitiveness of the company. Based on those factors, I recommend Palo Alto Network to be having an average competitiveness, as its rivalry among competitors is pretty average because there are large legacy corporations fighting for the same space, and this is an industry which would be disrupted very fast due to AI. Further, bargaining power versus suppliers and customers is also below average, as Palo Alto Network is heavily dependent on OEM Flex for its majority hardware that it requires to train its AI systems. Palo Alto Network is also dependent highly on the customers, as these are big conglomerates and corporate clients that have in the past put pressure on cybersecurity companies. The threat of While the threat of new entrants and threat of substitutes is pretty good, as this industry requires to build trust, and once a company has switched to a particular cybersecurity player, the switching cost becomes so high, and it's only increasing as Palo Alto Network is adopting platformization strategy. Now let us look at the leadership and ownership structure for Palo Alto Network. It's in pretty good hands with Nikesh Arora being the chairman and CEO of Palo Alto Network. Nikesh Arora himself has been the chief business officer for Google and CEO of SoftBank, for some of the leading companies in the industry for past few years. While Nerzuk has himself been a major employee of Netscape and for which is a very big cybersecurity player next to Palo Alto Network. So this brings the technical as well as managerial expertise into the founding team, and they are a pretty good team. Now let us look at the institutional ownership. So 88% of the company's institutional shares is owned by institutions, with around 4% by promoters. This number is consistently low, but it's increasing, which helps us to see that the promoters have a good faith in company's overall forward growth. Now let us look at the world-class benchmarking scorecard that is developed by Andy Stodd's investment research. We can see in profitable growth, Palo Alto Network has covered up really well in the past 2 to 3 years, where it was lying in the bottom decile, and currently it's one of the world-class companies. This is largely due to both improvement in profitability and growth. As for both of these, you can see the numbers have significantly increased. Uh, Now we will look at each of these line items going forward. So, profitability is measured using the return on assets, which has currently increased and it's 17% at present, which makes it world class. Its EPS growth is also very high, and Palo Alto Network has significantly improved its overall EPS growth. uh, Company's asset utilization is really poor, and this is something where the management should look forward to improve to maintain its world class status. While its company's net margin is also again world class with 36% net margin, one of the really great net margins in the industry. Palo Alto Networks sales growth is also really good, with this component being in the top three deciles or four deciles consistently. The company's net margin change is also world class, and it has consistently improved for past 2 to 3 years. So now let us look at ESG. The ESG scorecard for Palo Alto Network looks really great, and the only major challenge being governance. Company's social score is almost 100%, and its governance is 60%. This is largely due to the chairman and CEO being the same person, and the company's average score of independent directors being the national average. Palo Alto Network should clearly look at these. This has not been a major concern, but it could hamper the potential investors from coming into it. So let us look at the profit and loss statement for Palo Alto Network. The company's revenue has been consistently increasing, and it's expected to grow at the same pace. Company's net profit is also excellent. Palo Alto Network's short-term investment, I have forecasted to be consistently high. This is to maintain its agility in adopting new innovations and investing in new tech. Palo Alto Network's intangible assets and goodwill have also consistently improved. is also expected to consistently increase. This is largely due to companies' acquisition of smaller startup players to make the potential disruption in the industry, and intangible research due to consistent R&D that the company is doing. Company's long-term debt is zero, and I forecast this line item to be zero going forward. Palo Alto Networks net income is really a turnaround. As you can see, a negative net income around 2022. Palo Alto Networks for its entire history has made net income less than zero, but due to the platformization strategy and improving, so it has improved, making significant improvements in its gross margin and net margin overall, and now it has come to the point where it is making consistently positive profit. This number is only expected to increase massively going forward. You can see in 2024 the net income was 2578, but this is expected to decrease because in 2024 there was one time reversal of deferred tax assets, which was a huge number, and this has inflated the overall net income, but it was still high, and this number is only expected to increase. So Palo Alto Networks receivable collection period, as you can see, is going down, as I have mentioned earlier, because of shifting to a subscription based system. This receivable overall is going to be down because the company takes upfront payment rather than taking payment going forward. Its company's gross margin and EBIT margin is also expected to increase. This is in line with what is happening, and how the company is improving its overall efficiency in both in terms of human capital, in terms of its overall expenses. Now, I have forecasted the revenue to grow at 13% as compared to, you can see, 17% in 2024. This is largely due to a slowing down in revenue growth overall. But but the platformization strategy is something which can really boost the revenue. So this is quite a underestimate of where the revenue growth is going to be. Company's estimated tax rate is going to decrease. This is largely due to Trump administration's policy to decrease the overall tax on corporates in US. Now let us look at relative valuation. So I've used 2026 numbers as compared to 2025 numbers. This is largely because there was a significant switch due to one-time tax reversal, and this number would become highly inflated. So I have rather used 2026 numbers, which is which is overall nullified the effects of the tax reversal in 2025 2024. So you can see Palo Alto Network is very expensive compared to its overall peers. But if you look the same number and compare it with its competitors, you will see that cybersecurity industry has the same PB to ROE ratio overall. Palo Alto Networks P to growth ratio is also really high, but again, this number is what is there in the cybersecurity market. So, if you compare it to its competitor, it's going to be very good. But compared to, but because we are comparing this with 619 companies in the US market, this is overall expensive. And finally, let's look at how we came to this valuation. So I used a risk-free rate of 5% and an equity risk premium of 7% in the US market. I used a terminal growth rate of 2%, which gave me a 217 US dollars per share using a free cash flow to equity based valuation method. Finally, let's see the sensitivity analysis. So, sensitivity analysis, we can see in all the cases. I have tried to switch the sales growth plus and minus 10%, and I have switched the gross margin by plus and minus 2%. In all the cases, you can see that the free cash flow to equity numbers are above the current price of 184. Finally, let's see the risks. So, Palo Alto networks have four major risks. One is the loss of reputation due to an undefended cybersecurity attack, as this could lead a potential domino effect with its major client leaving, because the trust is one of the main things required in the cybersecurity industry. Second, the distributor concentration risk, as we can see on the graph on your right, that there are four major distributors making up more than 60% of the sales that is done for Palo Alto network. Palo Alto Network's dependence on OEM flex is also a major challenge, which it has to look and diversify, as there is only one player that is manufacturing most of the hardware for Palo Alto Network. And the tariff and talent acquisition challenge posed by the Trump administration due to high tariffs and potential pot- potential visa breakdowns could also lead to some gaps that Palo Alto Network should look to fill out. Finally, let's come to the disclaimer. So, this report is only for information purposes. You are advised to have your view and do not take it on its face as it is. If you have any questions, you can contact me on the email that I have given below, which is ayushmgp1234@gmail.com. Thank you.
Great. Okay, so let's go through a couple points there. If you can go back to the
Yes,
PowerPoint or to the slide, and I want to look at, I just want to look at your balance sheet first. So let's go to the asset side of your balance sheet.
sure.
Okay.
Yeah.
Now I noticed there's a lot of other long-term assets in 2024. It's 8669.
Yes.
Do you know, have you seen what those are? I know in my model, it kind of groups a lot of stuff together.
Hmm. So, for Palo Alto Networks, the other long-term asset, there are some line items which are due to the depreciation overall, uh, which was because there are some certain line items which could not be clubbed together with as a new component over here. This
Hmm.
was clubbed together in other long-term assets
Okay, so now let's go down to the ratio section.
ratio section. Okay. Yeah.
Okay, up a couple slides.
Okay. Over here.
One more and one more. Okay, so
Yes.
was just because I don't see the longer term history in our data here.
Yeah.
Was the were the losses that were happening in the earlier years,
Yes.
were they long term losses, or was it related to COVID or something like that, or what? Have they just always been in a loss situation and they've just hit profitability?
So they have just hit profitability. The reason was that Palo Alto Network, while is still old, it's pretty new in the cybersecurity space. So for years, it was kind of a typical startup. So for these years, Palo Alto Network was burning cash, acquiring new customers, and during COVID also it improved because cybersecurity is something which is not very COVID dependent. And it actually boosted Palo Alto Network's overall income and revenue. And while doing this, company has hit the net income 3 years back, and this number is only expected to increase because Palo Alto Network has now shifted out of the growth, shifted out of that stage where it is like burning too much cash. It is now
Yep.
generated the overall system where it can like cover up its cost through the revenue that is generating.
Okay, so let's go back up to the P&L.
PNL, okay. This one?
Keep going up. Okay,
Yes.
you just passed it. There it is. Okay, so the big cost for this company is the SG&A, I guess the marketing expense for acquiring customers and the like.
Hmm.
And the gross profit actually is pretty stable. It's
Yes.
that cost. Okay, let's go back down then to the ratios again.
Okay.
So what you can see is that the gross profit margin is, it's pretty much flat. It's very high. Let's say it's about 70, and that's
Okay.
the last 3 years.
Yes.
And your forecast is saying, yeah, it's going to maintain about that.
Yes.
Okay, that seems reasonable. Now, EBIT margin has gone from negative 3.4, then up to 5.6, then to 11.
Hmm.
And on a quarterly basis, we can see that, in fact, it even went higher than 11. It went to 12, then 15.4.
Yes.
It seems as though the company's hit this sweet spot where its profitability can really accelerate because they can get more revenue with, not as high amount of SG&A. But
Yes.
your forecast for EBIT is flat at 12%, meaning you are expecting the SG&A to be rising, just as fast as the gross profit is. And I'm just curious, are you being conservative in that assumption, or is there a reason why we should make this assumption?
So there are two reasons why I am conservative and why anyone should be conservative. One is that the as we have seen, the human capital or the people are is the most major constraint to growth in this industry. And going forward, as the demand to supply ratio is decreasing, the cost to acquire talent would significantly increase. So the net income per employee that Palo Alto Network has been making would go down, because now to acquire the similar talent, company have to pay more because the talent have many places to go forward. So
Mm.
that is one of the reason why I have maintained this conservative estimate. Second is, as I have talked about earlier, the platformization strategy is something which is still being tested out. If it works great, then I think all the margins are going to blow up. This is a very conservative estimate for all the margins. But if it isn't going to work, it's something like which I shouldn't blow up on my own. I should wait. Like anyone should wait to see how this pans out.
Okay, let's
Yes.
go to the triangle, the world-class benchmarking triangle.
Okay.
And what we can see on this triangle is that the company truly has hit the kind of economies of scale point in the past 12 months where profitability is at 1, growth is at 1, and therefore profitable growth is at 1.
Yes.
And I would say that there's no reason to think that they can't maintain this high level of profitability or even rise.
Yes.
And, it seems like this type of product can see its growth being at, ranked, let's say a 1 or 2 or 3. Yeah, no problem. So I see this company as just breaking through the economies of scale and hitting massive growth.
So, Andrew, there is one thing that I would like to differ. So,
Yep,
the number that you are seeing, one over here, in let's say in profitability, this is largely due to, especially in profitability, this is largely due to a one-time deferred tax asset reversal, which has significantly pushed the net profit above the level where it should be. So, let me go over here.
yep.
You can see the net income that company is generating. You can see in 2024 the amount was 2578, which I have again skimmed down to 700 in 2025.
Yeah. So go up to the P&L and let's see that.
Yes. uh, yeah, so
Okay.
you can see the income tax overall was 1589 positive in 2024,
Yep.
and
Okay.
this has pushed the net profit very high, and this is what is getting reflected directly in the world class
Yep.
benchmarking
Okay.
scorecard.
Okay. So and that's a correct analysis because with WCB I use net profit because I try to keep
Yes.
it as simple as possible. But still the EBIT. Look at that EBIT of 1193,
Yes.
right? And remember, when we go back to the ratio page, I was talking about the EBIT, right? So
Hmm.
I'll take your point on the triangle, but at the EBIT. So let's go now down to your free cash flow.
Okay.
Keep going down.
Okay, sure.
Okay. So in this, we can see your EBIT forecast is pretty flat. I mean, EBIT is not growing at a super high pace. And um, and so your free cash flow maybe, would you say that your free cash flow is significantly underestimated or just marginally underestimated?
I think it's marginally underestimated. Again, as I've said, the because the most major cost, if you see the breakdown in SG&A between marketing and the cost that is going to that is going towards the employee, that is going towards the so that marketing spend is not that significant, and the other component is going to blow up significantly going forward. It has already blown up to an extent, so that's why I feel that making this conservative estimate is right.
Um, the one thing you may be missing on that one, and this is something I just don't know enough about this company. That's why I'm
Yes.
asking a lot of questions. Is that the labor costs, the personnel costs in SG&A
Yes.
are not the programmers and coders.
Yes, yes,
they are
Exactly.
accounted for in the cost of service or the cost of the product, right?
Yeah.
And so, yes, there may be overhead personnel, sales force and management and all that. So, what you can see is that if they have a steady gross profit margin, then you could argue that their costs are not spinning out of control for their personnel. Now, let me just go. Let's go to your valuation page. Just go down a couple pages. Yep. Okay. So now I'm going to make some assumption that you are too conservative on your free cash flow.
Okay.
And let's go now to the next page.
Next page.
Yep. So I'm going to say that now what you can see here is that the two levers you can turn are sales growth and gross margin.
Yes.
Now I'm going to turn the gross margin number a little bit because, that'll proxy for the EBIT margin.
Okay.
Now, here, if gross margin goes from 75 to 77,
Hmm.
the free cash flow value only goes from 193 to 196.
Yes.
So maybe part of what you're saying is that there's not going to be as much of an impact on the valuation, maybe because of already very high profitability levels or something like that. What are your thoughts? Okay, so now you can. I'm going to take the screen out of the presentation
Yes.
and just you and I talk for a couple minutes. My question is, what is it? What would it take for you to turn more positive? And if you did turn more positive, what would be the potential upside to this company?
So, there are 2 to 3 things that the company should do if it has to tap on this upside potential. Number one, it's going to work on its platformization strategy, upsell more products. So earlier, what all the cybersecurity companies were doing, they were sending one product, let's say DNS cybersecurity, or let's say AI based cybersecurity. But now these companies are bundling together, let's say 5 to 6 products and selling them to their client. Now, what this has made, this has increased the overall revenue that each of the company is making. Each the company is making from each of the clients, and if let's say one of the product is really great, then it turns the client to take on more products.
And and
Now,
and that and
yes,
that that is a low marketing spend, right? Because they're
yes,
not acquiring a new customer, they're bringing an existing product to a new customer.
right, exactly.
Um, okay, I mean, one of my feedbacks on this too is that in my experience as an analyst, there's not very many times that you see a real inflection point on the positive. We do see a lot on the negative for companies, but this one looks like that. So either I'm wrong about that because I just don't know enough about what's going on with the company, or I'm right about that. And I think that's the next stage of research on this company is really to try to really figure out on a quarter by quarter basis to try to really understand, are they able to continue to expand this EBIT margin?
Yes,
And if they can hold or strengthen that EBIT margin, then we have a potential of, a serious rise in the stock price over the next, let's say, 3 to 5 years,
yes.
because they're hitting that sweet spot.
In my opinion, uh, like Apple is to hardware, I would say cybersecurity it's Palo Alto network.
Yep.
So if they are, then there's no stopping point.
Yeah. So how does it feel to graduate from the Valuation Master Class?
It's really amazing. Taught me so much. So I'm come from a completely technical background, and this has gave me something that I really wanted to, because I am doing my AI research in finance. So it has gave me something which I really wanted to know what is behind all these numbers, how to make sense of these numbers, and valuation masterclass was really amazing. I mean, the entire team from Momin to Pete, the weekly analysis, the weekly feedbacks on how I am, what I'm doing, the push forward. Exactly. I think this is one of the places which really push you forward to like grow out of your domains and make the real transformation. So it's
Yeah.
pretty amazing.
And what was your undergrad?
So I am doing a dual degree program. It's like a BTech and MTech combined. My BTech was in electrical engineering, and currently I'm doing AI.
So the point is that you're the type, what we call non-finance professional, person who's studying or working in a non-finance area that wants to either work in the world of finance or wants to understand it better. And
Yes.
so it's a great thing to think that we're able to serve that market, because many of the people that come from that space really haven't done any prior study of finance and accounting. I wonder what your advice would be for somebody that is an engineer that wants to become a finance person. They may feel overwhelmed about all the material in the Valuation Masterclass. I'm just curious, what would be your advice or your thoughts that you would give that guy if he was asking you?
So I would say it's not maybe that overwhelming. I think it the main thing that is required is a proper guidance. So if there is someone, so before joining this masterclass, also I was pretty much going through some of the materials. So I really wanted to know about finance, but that was something where it didn't make a proper sense. This was not a complete story, but rather in masterclass what happened that the overall videos every week, the every week there was tracking, every week there was this information that made this story complete, and that is something which really helps out, which makes it easy. It's not very overwhelming with the right guidance, but yes, if someone goes on it directly, think maybe he can do it, but it would take some effort.
Have you taken any other online courses?
I have taken, there is a course by Yale on finance. There is another course by MIT, but that is on more technical side of finance. So
And what's the difference between the Valuation Masterclass and those types of other types of online courses?
So one is the personal feedback, like rather than over there, it was completely online. Like you get feedbacks overall, but in masterclass you get weekly personal meetings. You are there, moment is there, feet is there, and that is the personal touch is something which I really liked in the masterclass, and the real push forward. So in other online platforms, maybe you can lag, maybe you can take 6 weeks for a thing that requires only 2 weeks, but here you get a constant push and you have to complete the things within a deadline. So that is really wonderful.
And if we go back to when you first entered it compared to today,
Yes.
what is the most significant transformation of that period of time?
So I think the ability to understand, ability to read the story, read the annual report of the company, and make out how and where it is going to go forward. At least have a hunch of most of the things. I know I'm just still starting, but I can now have a hunch. I can now argue with someone. I can have a debate with someone. I just had a debate with your platform last week. It was amazing. Like I can talk to people in finance and tell them my side of the story. Whereas earlier I was like, okay, maybe I don't know.
It would have taken you years to get there.
Yes,
Yeah, that's amazing. Well, congratulations, and onward and upward. I know you've got some great research that you're doing, and I think you've got a great start into the financial markets, and I'm going to be following you.
sure, Andrew. That's a great compliment.
Yep. Congratulations. I'm going to remove you from the group and talk for just a minute, and then I'll see you in a bit.
Sure.
Yeah.
Thank you.
Well, that was a great presentation on Palo Alto Networks, a company I've never looked at. And so I had a lot of questions. At first, what I was thinking was that the net margin was really, really improving. But what Ayush made a point, which was a good point, is that, well, don't be misled by what would be considered a non-recurring item in the net profit line, which was related to tax and a tax gain. So it's an important point to remember whenever we're valuing a company, that we always want to look at the recurring profit of the company. But sometimes in analysis, it's okay to look at net margin because, I'm looking at non-recurring, let's say. But it's an interesting one, and I just thought it was a great presentation. So if you want to build a competitive advantage in company valuation, join us at Valuation Masterclass